Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
A global sell-off, which suggests that a lot of money was raised in Japan at zero interest rates and used to speculate in other parts of the world. So I think that's all coming unglued, and I think it's a lot of margin calls, and I think it's going to happen pretty quick, and the unwind should be over by the end of the week.
That's actually our base case, is that we are going into a recession. We very well might already be in it. The issue is recessions are usually defined a year or so after the fact. And what we're seeing now in especially the unemployment rate, it does look like what you would normally see in early stages of a recession.
What's not happening is somebody didn't wake up this morning and say, Apple, Amazon, and Microsoft are worth 5% less than they were on Friday. That's not happening. And so that's what's important to remember right now, is that fundamental-based investors really haven't changed their mind about the world since Friday.
We got 1 hour to go until the market close, so let's take a look at the major averages. Things not looking quite as badly as they did earlier in the session, but still not great, right? We've got the Dow off more than 1,000 points now, 2.7% down. The S&P 500 still off 3.2%. I should say stocks sort of came up to the highs of the session around midday, but then they've been trending back lower. And the Nasdaq, the big loser here, down by almost 4% right now as we see just this shift in sentiment, but also it seems like a sort of technical shift in the markets as well.
Yeah, and bringing up some other questions too, Julie. Folks are asking, how should the Fed respond? Should the Fed respond? That was interesting. I was going back and forth with Joe Busuelis over at RSM, and we both know Joe, and I checked in with Joe just to get his take, and he did think, listen, if this keeps up, and he said you had another flat CPI and or PCE reading, then he thinks an intermeeting Fed rate cut, and by the way, he was saying a supersized one, not 25 but 50.
Right.
In his opinion, that would be on the table.
I mean, at one point that was being priced into the markets today. It's gone a little bit less to that, but a couple other things that we got to point out here. The huge spike that we saw in the VIX at one point, on a point basis, the increase today was the most going back in data to 1990. And the other thing that a couple other things we've been watching closely. We've been watching the 10-year yield, which earlier was down much more. At one point today it was positive, now it's negative again. And then the other thing we have to talk about, which we just heard Ed Yardeni talking about, is the Japanese yen. And I'm going to pull this out to get a better look at the big movement here in the yen. Now this is dollar yen that we're seeing here. And so this unwinding of the carry trade, which we heard Ed Yardeni refer to, effectively means the folks who were borrowing in yen to invest elsewhere, when you see a big abrupt move like that, you see a reversal of those trades, which helps explain, at least in the minds of Ed and many others, part of what's happening today.
All right, let's get to Yahoo Finance's Jared Blickery now with more on the market action, including a major sell-off in crypto. Jared.
That's right. I'm really glad you started with Ed Yardeni and also the Japanese yen. You did an excellent job of explaining the dynamics involved here. And just real quickly on the yen, within the last 5 days, it is down 6.5%. That is astronomical. In currency terms, that is just a lot of upheaval. And I think that's what's really just kind of leaking into the rest of the markets here. The VIX just had that huge spike up. The biggest jump since 1990, that's when the VIX began. So that tells you a lot that this was a record move today. Now here's the Nasdaq 100. I'm going to actually come back to that in a second. Want to switch over to the sector action. Interestingly, only tech is underperforming. That's down 3.5%. But you see everything in the red here. Industrials down 1.7%, and that is the best off. Also, consumer discretionary, financials, communication services, healthcare, materials, real estate, all of those down more than 2%. And you really see an unwinding here when we look at the Mag 7. At one point early this morning around the lows, they had been down by the most ever. I think it was $800 billion worth of market cap, but they've clawed a lot of that back. Nvidia was down 14%. Guess what? It's only down 6.5%. So this could be a one-off scenario. We're not going to know until we have confirmation over the coming days and weeks, but it's looking more like a one-off than the start of something much more protracted. But again, it's really in the early innings. Want to check out our leaders here because Bitcoin is the worst off today of everything. But that, like stocks, is also off the low. You can see Bitcoin down 9% over the last 2 hours, but it is actually up about 10% from the lows that we saw, this double bottom that we saw earlier today. So a bit of volatility here, things trying to make a comeback. We just have to see if it sticks.
We will. So we'll be counting on you in the coming days to help us keep track of that, Jared. Appreciate it. The global market sell-off reflecting a wide array of worries facing investors. One top concern being the health of the U.S. economy and the Federal Reserve potentially being behind in cutting interest rates. To check that pulse on market sentiment, we have former PIMCO CEO, Cambridge Queen's College President, and Allianz Chief Economic Advisor, Mohamed El-Arian, joining us now to discuss. Mohamed, as I said to you in an email earlier, there's almost no one I would rather speak to today to get perspective on what's happening. So I'm really happy you could make the time to speak with us. I want to start with something that you have said to us frequently over at least the past 6 months, if not longer, which is that the longer the Fed waited to cut rates, the higher the chance of something breaking. Is that what we're seeing happen right now?
Thanks for having me, Julie. We're seeing red lights on three things: fundamentals, policy, and technicals. And they are feeding onto each other. And the question is, will they simply run themselves out, or will they result in something even worse? So on the policy side, I've been of the view that the Fed had waited too long. They should have cut, they didn't. And now they're perceived to play catch up. And it's incredible to hear people calling from an intermediate cut. That is quite amazing that that's what some people want to see. It's not going to happen, but that's what some people want to see. Why is this of concern? Because the economy has been slowing faster than the Fed and others have been anticipating. That's the red light on fundamentals. And then you get the technicals, the unwinding of levered position, including out of Japan. So what we're living through right now are these three blinking red lights, and we need them to turn yellow and then green.
Mohamed, I'm curious because I was talking to Joe Bruce-Wallace, economist over at RSM. He was making the case, Mohamed, to me that, listen, if what we're seeing continues like this, and we got another flat reading in the CPI or PCE, then he did think an intermediate cut and a supersized one, by the way, 50, would be on the table. You seem skeptical, Mohamed. Why are you skeptical?
Because I think that would signal panic. It would signal total panic. You normally get those sorts of cuts when there's a major exogenous negative shock. When, for example, you have the pandemic, when you have Lehman failing, when you have something that comes from nowhere. What we're seeing here is simply an economic slowdown and a Fed that's behind. For it then to do an emergency cut would give the completely wrong signal to the marketplace. And in fact, it could contribute to a recession because people could get more worried and spend less. And that's what we need to avoid, this self-reinforcing negative spiral.
Well, as it is, with the economy slowing, as you probably heard, we've heard from some folks who are saying we are already in recession or we're close to it. I'm curious to get your take on that. And if we are at least close to a recession, where is that slowing coming from? And I think of, recent past recessions, obviously the pandemic precipitating event, the housing crisis and subprime crisis for the precipitating event for the financial crisis. But what is that thing this time around?
So, Julie, as you know, from months ago, at the beginning of the year, I put the probability of recession at 35%. It is not dominant. It's not over 50%, but it is a fat tail. What was I worried about? Two things: the lower income part of the household distribution and small businesses. They were already under pressure. On the household side, pandemic savings ran out, credit cards have been maxed out, and all they could rely on now is labor income. So if anything happened to employment, that segment was very vulnerable. Small businesses had also run down their cash balances, and we're finding borrowing costs very high. Now, people responded saying you over-worry. It's nowhere near 35%. It's more like 10% because this is a K-shaped economy. Yes, the lower part of the distribution is doing badly, but the other part is doing fine. So on average, everything is fine. What we've discovered is that the weakness is migrating up. And that's what the employment report told us. That's what the ISM employment index told us.
I'm curious, Matt, for investors who are watching right now and they see the reaction in these markets and they're trying to gauge what comes next. What should they be watching, Mohammed? Are they watching the yen? Are they watching the bond markets? What are you watching?
I'm watching market technicals. I think we are in overshot territory in several segments of the marketplace already. Certainly in fixed income, in terms of government bond yields. The sort of declines we've seen, especially at the front end of the curve, are, in my view, an overreaction. So look at whether this overreaction starts getting corrected or not. The ISM service number today reminded people that the economy is not completely in recession. It's a risk of recession, not in recession. So look at that. You need to see the technicals stop feeding onto each other.
And when we spoke with Ed Yardeni earlier, and I also saw this in a Wall Street Journal column from James McIntosh today, they were comparing this to 1987, right, where you see a Black Monday event, but that wasn't, in fact, followed by a recession, not for a few years. And we sort of had a technical snapback after that. Is that the best sort of analogy for what we're seeing?
Yes, if we can find an anchor. So the big difference with 87 and today is that the Fed was not an amplifier of volatility. The Fed was a stabilizer. Today, unfortunately, because the Fed became so backward-looking and the Fed lost a lot of credibility in the last few years, they've become an amplifier of volatility. And the way you get back to an 87 scenario is by the Fed regaining control of the narrative and the Fed making their forward policy guidance more effective and taken more seriously. Right now, the markets truly believe they can bully the Fed into doing whatever the markets want.
How does the Fed do what you're describing, Mohammed? I mean, obviously we have Jackson Hole, but that's several weeks from now, which feels like a long time in these markets. Is it about, and we don't have a lot of Fed speak on the calendar, there is some. So how do they retake control of that narrative?
Well, I think Austin Goolsbee today, the president of the Chicago Fed, was quite effective. And he did act as a mini circuit breaker in the morning at a really critical time when the fix was out of control and there was a lot of fear in the marketplace. Importantly is to take advantage of Jackson Hole. There's a number of things that are forward-looking that the Fed needs to share their thinking. Things as basic as what do they think the neutral interest rate is? That's really important. Unless you give guidance to the marketplace and stop this excessive data dependence, the Fed ends up being the amplifier of volatility. And that's what, we don't need a central bank for that. The markets can contribute to volatility all on their own. They don't need a central bank to amplify it for them.
Mohammed, another issue I've heard raised, and so I just want your take, is whether you think politics is playing any kind of role in the nervousness and the selling, Mohammed, and the idea being, listen, we have an election, the polls show now it's basically a dead heat. Do you think that is an issue that plays any kind of role, Mohammed?
So I had this image of Family Feud, you're too young, but you put up what the main factors are. So politics, domestic politics is fifth. The first one is a growth scare, then concerns about a policy mistake, then the bad technicals, then geopolitics and the possibility of an escalation of the Middle East war. And then finally, it's domestic politics. So is it there? Yes, but its influence is very small compared to the other four.
If only we were too young for Family Feud, Mohammed. I feel like I should be hitting a buzzer even just hearing that phrase. Mohammed El-Erian, always a pleasure. Thank you very much.
Thank you for having me.
We have to get you caught up with some breaking news here. Google losing an antitrust lawsuit brought by the Justice Department over its search dominance. Now, a federal judge has ruled the company's payments to make its search engine the default on smartphone browsers actually violates U.S. antitrust law. And this decision coming down just in the last few minutes here as we try to figure out what exactly are the implications of that. This is one of a number of suits that have been brought and different regulatory actions that have been brought by the U.S. government here.
Yeah, I mean, I think Google would probably, trying to make the case that, listen, I mean, consumers have choice and, partners want to team up with this because we've got the best product. When Julie and Josh want to search for something, they use us. But that apparently is not what the judges decided here, saying that really Google, the payments they're making, and of course, it's a lot of money. It's billions and billions of dollars.
Yeah.
The judge deciding here, actually, that's blocking rivals from kind of really competing and succeeding.
Yeah, $26 billion in payments total here is what we're talking about. And the judge in the case, Judge Amit Mehta, writing in his ruling, Google is a monopolist and it has acted as one to maintain its monopoly. Now, as I mentioned, there are a number of different actions that are outstanding. This is one of the most significant ones, and one would think it'll be it will be pushed back upon by Google, but we'll end up seeing what happens. The stock did fall to the lows of the session, or back towards the lows of the session.
And comes at a time, Julie, and we've talked to any number of smart analysts about this, and they have different opinions, but obviously, comes at a time when, investors certainly have new questions about Alphabet's bread and butter search business. In the age of AI, how is that going to be upended and redefined?
It's a great question. Yep. All right, we're just getting started here on market domination. Obviously, very busy day here. Stocks heading for a big loss to kick off the week. Stay tuned, much more still to come.
Stocks under serious selling pressure here, but off the lows after what started as a scary open for investors. And joining us now is Mark Newton, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy. Mark, you are the perfect pro to have on today, my friend. Let's start big picture. What do you make of this sell-off, Mark? What are the charts telling you?
Thanks, Josh. Well, look, a lot of this has been specifically technology related. And I think investors are trying to come to grips with this new era of really cross-asset volatility that's affected not only large cap technology within equities, but also interest rates and FX. And we're seeing cryptocurrency declines. And so it's really a new era where a lot of these have been declining at once. I mean, the one thing I would say is that you really haven't seen that big of a degree in broader market weakness. It's largely been technology. However, that is, of course, something that affects most of our major indices and ETFs, and it makes the market seem like it's showing a big decline. But there are a lot of healthy parts in the market, and we can talk about that in a minute.
Well, Mark, that has been true largely in recent days, but today the selling has broadened out, right? We're seeing it a little more pervasive throughout the markets. Does that tell us anything? Are you sort of taking away anything about how long this could last?
My thinking is it likely bottoms this week. Tough to say that it has bottomed as of yet, but I specifically think that either this week or next week will bring a short-term low to this decline. And I say that specifically for a few reasons. One is that dollar yen, which is at least one of the reasons why equities turned down so sharply, was a huge change in policy. BOJ cut their bond purchases in half and obviously hiked rates. So we saw a big surge in the yen, and now we see this the entire trade is being unwound in the last few days. And so I think that's really interesting. And when you look at the carry trade, where people borrow cheaply in yen to potentially buy large cap technology issues, some of that has been alleviated. And now we're seeing the yen rise right to near prior peaks, or in this case, lows for dollar yen, which is 140.23. So that's going to be pretty significant support in the short run. And so I think that is really, really important. The second is that you're seeing sort of a dislocation finally in excessive volume to the downside. We never really saw that over the last few months. And so volume was a very orderly type decline. Now you're seeing a huge amount of advanced decline to the negative, meaning huge amounts of declining issues versus advancing volume into declining issues. That's giving you your first real whiff that we're getting close to a low at a time when the VIX got up near 60. And a lot of these fear gauges, when you look at just traditional sentiment polls, have turned very negative in a very short period of time. So when I look forward and I see, the Fed now has basically, we're seeing in the market pricing in a good likelihood of 125 basis points of cuts by December. That's interesting. For the first time, the chance of cutting in September has been raised from 26 basis points to over 50. So two 25 basis point cuts, a 50 basis point cut, which Powell was dismissive of as of last week, now is at least built into the market. So the market's gotten fairly valued, huge sell-off in technology. People have gotten scared. Obviously, it's a difficult time of the year in an election season between August and November. But I sense that, this is going to bring opportunity for those that like to buy dips, because I don't sense that this fear is really, makes a lot of sense based on looking at broad-based nature of what's happening across the globe.
Mark, you mentioned how there's some healthy parts of the market, which is welcome news on a day like this. Where are you seeing that, Mark?
Oh, just as early as really look at last Thursday, and we saw the XLV, the healthcare ETF, hit new all-time highs. And keep in mind, this is right in the midst of an ongoing sell-off in the market that started back on the 16th of July. And so this has been going on for over 3 weeks. And now you have healthcare hitting new highs. A week before that, you saw equal-weighted industrials and equal-weighted financial ETFs, RSPN and RSPF from Invesco, both hit new all-time highs. So we have a few different areas of the market that actually were acting quite well, but all of this continues to be disguised by, technology. This big tech wreck has served to really camouflage the market. And yes, it's very painful. I think investors have been overexposed, have huge concentration in technology. So a big sell-off like that at an area which is a major focus certainly hurts. But I would say that honestly, for those that diversify, there are plenty of parts of the market that are still working well. And now with a big breakdown in the dollar, that eventually is going to start to aid emerging markets when we can see a little bit of stabilization to this.
Mark, I want to ask you about one other area of the market that's not doing well, and that's crypto. You guys, your firm has been big bulls, notably on Bitcoin. And one of the theses with Bitcoin as it being quote unquote digital gold is that people should flow into it at a time like this. But I guess if you're borrowing in yen and buying Bitcoin in dollars, you know, that's not necessarily gonna help you out. So I don't know. I'm just curious what your thinking is right now.
Well, as a technical analyst, I would say that despite the fact that there's no perfect correlation between really Bitcoin and the Nasdaq anymore, I mean, Bitcoin largely has been going sideways since March at a time when the broader market really was going sideways for a number of months before breaking out. So Bitcoin largely has been range bound, you know, for the last few months. It obviously feels pretty severe when you see a big move from the highs like we saw, but compared to the move that we saw, you know, in the rally from last year, you know, it's really just a drop in the bucket. And if anything, you know, our head of digital assets, Sean Farrell, remains very constructive. And you know, my own thinking is that I don't see much more deterioration beyond really the mid to high 40s. And I think we will bottom and we can pull out of this. But it is going to be important for, look, the broader risk asset space to stabilize. It's very unusual and unlikely to see Bitcoin simply surge back to new highs if the rest of the world is falling apart. So we need to really see some effort in dollar yen holding, to see rates go down a little bit less severely, as you know, they've really been hastening in terms of how quickly we've seen the 2-year fall apart and the 10-year. And a lot of that started off based on disinflationary, you know, promises that was good news, and then recently that's turned into a little bit more of a growth scare. So that's, you know, I want to see rates stabilize a little bit, want to see the dollar, you know, despite it being in a downtrend of late, and really see technology sort of hold where it is. The charts of RSPT, which you showed at the beginning of the interview, you know, that's getting down to very important levels. And so technology, you know, might take a while to get back to the highs, but it is certainly a very, very intriguing area to consider. You know, you look at Nvidia's forward PE now of 26, very reasonable, you know, ahead of the Fed, of course, set to cut as many as 5 times over the next 4 months. You know, for me, that seems pretty attractive at current levels.
We'll see how things play out the rest of the week and the month and the year, Mark, and we'll catch up with you again, I'm sure. Good to see you. Thank you.
Likewise.
We're getting to one individual trending ticker that we're watching. It's Nvidia. Those shares are under pressure as its new AI chip could face a delay. That's according to a report in the information. Now, that report came out late last week, but it's still affecting the stock here this morning as it pushes back by 7%. The information saying that there was some concern about design flaws. Now, most of the analyst chatter I've seen about this has said they think that Nvidia can overcome this and that it'll be fine, but the market is definitely punishing any negative headlines today.
Yeah, Bernstein Stacey Razgon telling clients is not panicking at this point. A push out / delay of shipments, if they occur, may shift timing of some revenues, but seems unlikely to impact broader demand. So in other words, Stacey's saying if there is a delay, sales, he believes, you know, deferred, not destroyed, outperformed targets 130.
And we should mention we got a statement from Nvidia on that report, and they said, as we've stated before, Hopper, that's their chipset, demand is very strong. Broad Blackwell sampling, the next generation, has started, and our production is on track to ramp in the second half. Beyond that, they said we don't comment on rumors. In the meantime, Nvidia's shares are down some 25% since their record high on June 18th. That has erased market value of about more than $840 million in that period of time.
Earnings coming up later this month.
Yeah.
All right, meanwhile, Warren Buffett's Berkshire Hathaway slashing its stake in Apple, selling nearly half of its Apple stock. So this certainly generated a lot of headlines and attention, Julie. Berkshire cuts the Apple stake roughly in half. How do bulls respond to a headline like that, Julie? Well, Dan Ives over at Wedbush does note Berkshire still has Apple as its #1 position. It is more than double its next biggest position, which is Bank of America. We strongly caution, Ives says, that Buffett is a core believer in Apple, and we do not view this as a smoke signal for bad news ahead.
I mean, there are a lot of defenders out there of not just Apple, but of Berkshire's selling of Apple and saying it's sort of technical here because it had become too large in the portfolio because of its gains. 2016 is when Berkshire Hathaway first disclosed that stake, and since then the shares are up almost 900%. And so obviously it's gained a lot in the portfolio. By the way, I just told you how much Nvidia is down from its record. Apple down about 11% from its record a few weeks ago, and that has wiped nearly $400 billion from its market cap in that period of time.
We don't expect more news from Apple now for a bit in September. That's when we'd expect
Unless
Tim
there's
Cook
some leaks
to make the stage.
We'll see.
I always count on a few leaks. All right, stay tuned. We're going to be right back with more market domination on the other side.
Wall Street sell-off intensifying to start the week, declines hitting every sector, with oil sliding to a new 7-month low on signals of faltering demand in the U.S. and China. And ExxonMobil is fresh off results that beat estimates on earnings and revenue for the second quarter. Joining me now is Catherine Michaels, ExxonMobil Chief Financial Officer. Kathy, thank you so much for joining us. We really appreciate it.
Thanks so much for having me, Julie. Really happy to be here today.
So I just want to talk about the backdrop a little bit here, because we do have this sort of shifting sentiment that's reflected in risk assets and stocks and oil, shifting sentiment around the Federal Reserve and economic growth. And I'm just curious what you're seeing in your business, whether you're seeing any signs of an economic slowdown, how that's affecting demand dynamics right now.
Yeah, I think it's really important to put it into context for our industry because we were coming off of record highs last year, especially in terms of refining margins and gas prices. And what we've seen more recently is that price and margins have come back into what we would call the 10-year range band. So that's pretty consistent with a still pretty constructive market overall. It's really only our chemical business where we've seen and continue to see bottom of cycle conditions. And importantly, the work the company has done to improve our underlying earnings power, that's put us in a really good place in terms of just resiliency of that earnings power through any market environment. And so just this quarter, we saw our earnings increase $1 billion relative to the last quarter. And I think that really reflects the decisions that we're making around our portfolio and investments and continuing to drive efficiency across our business.
And then looking over the much longer term here, something that your CEO, Darren Woods, mentioned on the earnings call is that your global oil outlook is about to come out. And he kind of gave a little teaser here that global energy demand should rise 15% between now and 2050. As you think ahead, and obviously that it's tougher the further out you go, but what would be sort of the main risks to that kind of outlook?
Ultimately, as we look at the outlook, we continue to see really strong demand. And so last year was a record high in terms of oil demand. We expect this year is going to build on top of that, and that 2025 we'll see yet another build on top of that in terms of overall demand. And that's really driven in large part by countries trying to address energy poverty, right? Having low-cost, reliable energy is one of the things that really drives economic growth and pulls people out of poverty. And so that's a big driver of growth. And then overall, oil demand is a feedstock that's used for industrial capabilities like chemicals. And so you continue to see the wide variety of uses for things like plastics and other chemicals that, again, drive oil demand.
As we look at your last quarter, you had record production in the Permian because of the Pioneer acquisition in part, record production in Guyana. If you could just briefly say what you think investors need to know about Pioneer, the integration, and what's that going to mean for cost savings and production going forward?
Yeah, absolutely. We had record production in our own Permian operations as well, along with, as you mentioned, record productions from Pioneer's operation, record productions in our Guyana operation. And so it was just really a strong operating quarter for the company overall. And, you know, as we look at the combined now Pioneer, ExxonMobil, Permian operations, we see even more opportunities for synergies there, which we're getting out in front of already. And so just as an example, Pioneer has a remote logistics operations that ExxonMobil has now taken on and added into our remote wells and completions operations in order to drive more synergies across logistics and procurement. We are starting to utilize what is a very large water recycling infrastructure in the Midland Basin that Pioneer brings to the table. And so looking to get those synergies, which are also environmentally friendly, help us to reduce our environmental footprint. We're beginning to align overall specifications for the materials that we procure. Again, that'll drive both procurement synergies as well as supply chain synergies. And then finally, I'd mention we're beginning to use our techniques in terms of what we call cube development, longer laterals, in order to get higher resource recovery more efficiently on the Pioneer acreage. So we feel like the integration, planning, and execution is going really well, and that we can already see the opportunity for more synergies than we laid out at the time that we originally announced the acquisition. So everything's going really well.
And Kathy, finally, I feel like I got to ask you a Guyana question as well. And now this arbitration hearing over Chevron's proposed acquisition of Hess, it's been pushed back, it looks like, at least to mid-2025. If Exxon does not prevail in that proceeding, what's the kind of game plan there? What will Exxon then do?
Yeah, so importantly, I'd start by saying we felt really good about the arbitration panel timeline. So we always felt like this was a situation that deserved for people to take time in order to really inform all the data and all the circumstances to interpret the joint operating agreement, which is what the arbitration panel has in front of them. And so they've set a hearing at the end of May of next year and said they'll make a final ruling by September. And we think that's a timetable that allows them to really digest and take all the facts and circumstances into consideration. And then to your question, Julie, kind of what happens if for some reason we were not successful in affirming the preemption right that we have? Our expectation would be that the Chevron-Hess transaction would move forward. But in the next breath, I would tell you, we feel very good about our position in this arbitration, being one of the parties that actually negotiated the agreement that's being discussed in the arbitration.
Gotcha. All right, Kathy, thank you so much for your time again. Appreciate it.
All right. Thanks so much, Julie. Really appreciate being here today.
Just over 20 minutes till markets close. Let's get a check in on the markets with Yahoo Finance's very own Joshua Schaefer.
Hey Josh, yes, you're seeing all three major averages still trading near their lows of the day, coming up a little bit, but I've sort of been asking strategists throughout the day today just essentially what they make of the market action, what they feel like has been driving it, and sort of where stocks go from here. So the large take has been sort of something that you guys have obviously already talked about on the show, kind of the unwinding of this carry trade from Japan, being what started weighing on markets. You could really probably even go back to last Friday's jobs report, saying that also was partially what is weighing on markets, right? This economic data shift and how we're receiving data and sort of bad news becoming bad news. What I thought was interesting that I heard from two different strategists, though, was essentially that when you look at what's being pulled down the most, it's the most crowded trades, and that's kind of a call that we've been hearing for really over a month now, maybe 6 months, maybe you could say it's been a year, that people have been circling that concentration though, right? And saying at some point this is gonna unwind, at some point this is gonna unwind. And when we just think about this market action, you guys were just talking about Nvidia down, I think over 6 or 7% at this point today, probably 30% in the last month now. That's a call that people have been talking about. And sort of the takeaway from the team at Citi was, well, if the crowded trade was what brought everything up, that's what's going to happen on the way down too, and also getting to the point of maybe that's not a bad thing. This is what people have been talking about, right? We want that unwinding to happen so then you have more of a normal market. And essentially the big tech earnings that we got last week didn't meet these really high expectations that we have. So then you get a little bit of jitteriness, a couple technical things happen, and then it all starts unwinding.
Well, and let's talk about the magnitude of that unwind, because those always get a lot of attention. So the Magnificent Seven in particular, what the market cap erasure today, is that a record? Is that what's the current?
I think it was close to a record. We had a record last week, right? So we're recreating their own records, I guess, at some point when you start to look at that. So that's been definitely an area to watch, Julie. And I think the interesting part of that is what's the near-term catalyst to bring the Magnificent Seven trade back? And I don't really know if you have one.
I mean, we got to wait until the end of the month for Nvidia. We were talking about that earlier. The timing of Nvidia's earnings is inconvenient, I think, for the rest of the market and from catalyst purposes, or it's a boon if they're going to come out and beat as they have been.
And I also wonder, though, when you think about that, and we talk about these big tech stocks in that group all the time, right? How much will it matter if Nvidia does the Nvidia earnings thing again and they surprise and their earnings are going up? Like, does that tell me that the other stocks are going to monetize their AI strategy? It seems like we're getting to a point right now in market sentiment where investors are questioning that thesis more. That just the broad AI trade is all one thing. And if AI is hot, then everything in AI can go up. I think one of the bigger takeaways I have from the last 2 weeks of action is just the AI trade in general is under more scrutiny and is being viewed differently depending on what company you are. And so I don't know, it'll be interesting to see when Nvidia does come out. Can they sort of bring that narrative back, or are we at a point where the AI trade is never just one trade anymore?
More selective.
Yeah.
We'll find out, but we have to wait.
TBD.
Okay, thanks a lot, Josh. Appreciate it. Coming up, a federal judge has ruled that Google engaged in illegal practices in order to maintain its dominance in internet search. Stick around, we'll speak to a former FTC chief technologist on the other side. In today's Yahoo Finance Playbook, we're taking a close look at the biotech sector and opportunities outside of GLP-1s. Joining us now, Salveen Richter, lead analyst for the U.S. biotechnology sector at Goldman Sachs within Global Investment Research. Salveen, thanks for being here. Thanks for coming in. So I want to start sort of big picture because we are on a day here where we're seeing this very dramatic sell-off across assets. And I just wonder kind of how you think about biotech as strategically as part of a portfolio at a time like this?
Well, I think when you look at healthcare, you tend to want to gravitate towards the more defensive sectors in a period like this. Within biotech, there are defensive aspects, but there are non-defensive aspects. So with regard to rates, obviously a positive for the sector if we start to see a rate cut. But if you're in a recessionary environment, then you can kind of pass through that situation and people will determine where they're going to allocate for growth and more of a defensive play, which will probably be these larger cap, more quality-oriented names.
And which among those names, Salveen, in your coverage universe right now, where do you see the opportunity?
So Amgen's one, they're reporting earnings this week that we're focused on, and they do have a next generation GLP angle, or for obesity, but they also have a slew of pipeline products that have come out via internal R&D and then M&A. And so we're looking at them from an earnings execution standpoint, and then the ability to kind of own in different verticals within cancer, within autoimmune disease, and they also are basically leveraging the AI side of the world with regard to kind of bringing it in-house and mixing it with genetic medicine. And then Vertex and Regeneron are two others we should highlight, really strong R&D first execution stories. And with Vertex, they're looking at not only furthering their cystic fibrosis monopoly essentially, but also bringing in a non-opioid pain version, and then going further into rare diseases. Vertex is looking to build a cancer vertical and also looking to go into kind of innovative spaces in autoimmune disorders and others. So I think it's much more about where do you see innovation and sustainable growth and a kind of a first-in-class outlook, first-in-class, best-in-class outlook.
And it sounds like, are you also looking at the biotechs that are not sort of, I mean, even though Vertex has that dominant product in cystic fibrosis, they have some others in the pipeline you just mentioned. Are you sort of focusing also on some diversified plays, right, that aren't just sort of betting the farm on one particular treatment area?
Exactly. I mean, I think Vertex has done extremely well being a focused player, but the idea of diversification is key, right? As you think about growth levers, as you've penetrated a market. So they've been acquiring and innovating to kind of create that diversification. So has Amgen to that point. And now we're seeing Regeneron have to do it. So we've seen this with the large biopharmas or even just large pharmas. When they get to a point where they're too concentrated, they do have to work on diversification here.
Salveen, I'm curious, one kind of mega trend, no surprise, we talk a lot about on the show is AI. How are the companies in your coverage universe leveraging their technology, and how do you see it sort of just reshaping the biotech sector?
I think it's going to reshape the biotech sector in terms of being a tool that everyone brings in, and now it already exists as computational biology. So as we think of it's more of a I would say a gradual, stepwise function towards kind of maybe greater integration here. And so some companies, some large companies like Amgen, have gone out and been acquiring tools that they're bringing in-house to, quicken development, lower time to market, therefore lower costs, but also go after undruggable targets, right? And so there's work on that front that's being done. And so you've seen several large pharmas come in that way, and then you're seeing this emergence of a group that are calling themselves tech bio, and they really are tech companies and drug companies that have kind of merged, and culturally they are interesting because they're different from models we've seen, and working to create kind of next generation drugs here, and we'll see. I think some will succeed, some won't, but we're in early innings here.
Great, Salveen. Thank you so much for joining the show today. Appreciate it.
Thank you.
Moving on, Google losing an antitrust lawsuit brought by the Justice Department over its search dominance. A federal judge ruling the company's payments to make its search engine the default on smartphone browsers does violate U.S. antitrust law. Joining us now with more is Neil Chilson, head of AI policy with the Abundance Institute and former chief technologist for the FTC, along with Yahoo Finance's Alexis Keenan. Alexis, maybe I'll start with you. Just bring us up to speed on what do we know?
Right. So just a huge decision. I'm still parsing through it, so bear with me here. What the judge has found, and this is the judge in the district court in D.C., Judge Amit Mehta, he says that Google is a monopolist and that it acted to maintain its monopoly. That's a violation of Section 2 of the Sherman Act. And what the judge held is that there is a relevant market here. The place where he's saying Google is a monopolist, one, general search, right? When we go to google.com and we type in that field in general search. The other is general search text advertising. So Google's distribution agreements, that's what's underlying this case. Google enters into distribution agreements that really make Google's search platforms the default on mobile phones, on browsers, on places that touch the internet. So that's the foundation of this case. That's the trouble that the judge has with these exclusive agreements here. The judge said that Google also charges supra-competitive prices for its general search text ads. And also, there's part of this decision that does, though, favor Google, and that is in search advertising. The judge said that Google lacks a monopoly in that space, and therefore the inquiry stops there. They go no further. So the judge says they're not liable, Google not liable as an anti-competitive violator for what it would be targeting there as its SA360 product. The judge also said that there's no product market for general search advertising. But look, this is 237 billion of Google's 307 billion in total revenue for 2023 is advertising. Search advertising is 175 billion of that. So
right,
going to have to figure out. It's a huge deal. We're going to have to parse out
what we're trying to say.
Which sections of their revenue pertain to this holding here.
All right, I want to take it to Neil now, because Neil, Google's argument has been, we have these agreements because we're the best search engine. And I'm just curious why you don't think that the judge found that argument compelling.
Well, so the judge, I think, here focused very much on whether or not a lot of these cases are lost in the sort of market definition. And once that was found, Google does have a significant market share. And the judge parsed out the fact that Google is a monopolist in this market and then said, the problem here is maintaining that monopoly, not earning that monopoly. So being the best is how you might earn a monopoly, but then if you maintain it using anti-competitive conduct, that's what they were focused on here. And so the judge said that these contracts maintain that monopoly in a way that violates Section 2 of the Sherman Act.
And so, Neil, what are possible remedies here then?
It's a great question, actually. I think the court will have to look at that next. And divestment would be extremely severe here, and I don't think that seems like unlikely. But probably it's more in the form of invalidating these distribution agreements and saying that Google can no longer pursue those types of things, which is an interesting problem because under these agreements, Google sometimes pays significant amounts of money to these platforms for a product that consumers might switch and choose as their default anyways. And so if Google is the best, a lot of those revenue streams could disappear to some of these, say, browser manufacturers or Android platform creators that they won't easily be able to replace through other streams of income.
And Neil, I want to ask you about the changes that have happened in the past years since this case has been pending. Now we have AI-assisted search that is really changing the landscape of search. What do you think that will imply if we ever do get to a point where we are talking about remedies, barring appeals in all of this case? How does that change the possible fix here?
I don't know if it changes the fix exactly, but if the judge takes that into context, we're at a time where general search, the market that's at most issue here, is under significant threat, not just from AI, but also from specialized search. So the most money-producing parts of general search are those where people are searching for products, and fewer people are using Google to do that now. Many people start their search for products on Amazon.com, for example, and so I think the court will have to take that into context. The fact that general search is not quite the sole destination for the internet search user as it used to be in the past. And the new competitors from AI, I think, are putting even more pressure on this business model. And so the findings here are a little bit ironic that they're about a technology that is under significant pressure, not within the market, but from outside of the market in which it competes.
Neil, Alexis, thanks so much for joining us today on the show. Appreciate it. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
That is the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day. Not really off the lows, not very much here. The Dow down 1,033 points, 2.6% when all was said and done. The S&P 500 at one point during the day made a little bit of an attempt at more of a recovery before sliding through days and finishing off by almost an even 3%, and the Nasdaq down by 3.4%. All of this sort of triggered in part by the worse than expected jobs report on Friday. That's when the selling began. And then a growing perception that the Federal Reserve is behind the curve in terms of its rate cuts. Added to that, the action on the part of the Bank of Japan last week, sending the dollar lower against the yen, and so reversing some of the carry trades. We're going to talk about that later in the hour, but all of that affecting things, volatility spiking today, and also seeing the 10-year yield, interestingly, earlier going much lower and then finishing the day kind of flat. So, Jared, it's been an interesting one, to say the least.
Yes, it has. The big question is, do we continue selling tomorrow, or do we continue this bounce off the lows? And really, I've seen arguments, pretty good arguments either way, although the disaster scenario is looking less and less likely with some of the strength we saw off of the lows. Let me just show you the VIX real quickly, and I'll get that behind me. We shot up to 65. This was, as Julie, you mentioned earlier, this was the biggest single-day increase point-wise in the VIX ever, going back to 1990, still ended up by 38. That is a big number there. Here's the 5-year, and you can see in relation to the pandemic that we got there, the pandemic bump, still pretty high there. What I think is notable is that it was higher than anything we saw in 2022. All right, let's get to some heat maps here. Sector action, everything in the red. Only tech was underperforming, down over 3%, but seeing a lot of other sectors, most of them down more than 2%. Industrials off 1.67%. That was the best. When we take a look at some of the leaders, Bitcoin took the biggest hit, down 14% from Friday. Cannabis also not doing well. Korean stocks, which is heavily levered to the chip market. New York FANG, not surprisingly, not doing that well. But also, I want to show you China, because China, actually one of the few screens with some green today. Maybe a little bit of rotation there, or things are maybe just a little bit less bad over there. But Trip.com up 2.5%, EDU up about 9%. So a little bit of green at the end of a harrowing day.
I don't know if that's where you have to look for your green, Jared. I don't know. It's silver lining anywhere, I guess. Thank you. Appreciate it. Well, the market's closing the day deeply in the red here, but our next guest says this market downturn is more of a tantrum, and you maybe should consider buying the dip, at least judiciously. Joining us now is Anastasia Amoroso, iCapital Chief Investment Strategist, here with us in the studio. It's so good to see you.
Good to see you. Good to see you, Julie.
Even on a day like this, maybe especially on a day like this, so that we can sort of get some perspective on what is going on. So, how are you thinking about the sell? I mean, obviously the sell isn't just today. It has been gaining some steam.
Yeah.
What do you think it reflects, and is it going to keep going?
Yes, it certainly has been gaining some steam, and today especially feels like a tantrum, and I don't think that was really the case for the prior several weeks. And what I think today was partially about is the systematic unwind of a lot of long positioning. And of course, we knew about this. We knew that the hedge fund community was very long technology. We knew that the commodity trading advisors, the trend following traders were really long, and so they're working down some of that length. We know that retail buying has slowed down as well. So I think whenever you see this downward knee-jerk reaction, the first place you look at is technicals, and so I think that's what's at play today. But I do think that there's something else that's in the background, and that is, of course, this, I call it market mood to price in a recession. And, the markets got really spooked by the payrolls report and, this notion that you mentioned that the Fed is behind the curve. So I worry that every data point that otherwise might point to a slowdown might be being interpreted as weakness by the market, pointing to a recession. So I think that's the market mood right now. And you couple that with these really bad technicals, and that's why you get the action that you have today. But again, when you feel bad as you do today, you want to be looking to the other side and thinking about the things that can go right. So we can talk about that as well.
Yeah, that's what you kind of lead me where I want to go, Anastasia. So as you look to the other side, you were actually adding to some names today?
Yeah, so I think there's two ways to think about positioning in the current environment. First of all, we should acknowledge that this is a slower economy, and whether it's a recession or not, it is a slowdown. And so I would expect some of the defensive trades to outperform. So for some of the high-income bracket individuals looking to tax-exempt munis, rather, I think that's a good place to be. Looking at utilities and other defensive sectors, they didn't quite hold up today, but typically they would outperform the broader markets in the slowdown economy. So I think real estate is another part of that. If you think about the one beneficiary, the sector that probably benefits the most from rate cuts it's actually real estate. So we think about, having those buckets of trades in your portfolio. But at the same time, you look at technology, there's a lot of carnage there. And I'm going to stay away for now from the Max 7, most of them. But I am actually looking at semiconductors because, of course, that's the enabling trade. That's the artificial intelligence momentum. That's what it's built on. And that's where the CapEx is going to go. AI semiconductors have rallied a lot. Valuations were stretched. But now they're sort of on the other side of that. So if you adopt a longer term time horizon, I would say 6 months past the rate cut and maybe even longer, then I think you want to be stepping in and buying some of these names on the dip. I'm not saying all of it today, but over the coming months as some of the potentially positive catalysts.
Does that include an Nvidia, for example?
Well, I'm not going to comment on individual stocks, but if you construct a basket, Julie, of semiconductors that benefit from artificial intelligence, and includes several names, including the key enablers. But I will say, speaking of positive market catalysts, again, the market is jumping to this conclusion that we're headed for a recession. But the reason for that, of course, is the SOM rule that has been so greatly discussed and debated. And even the author of the rule has recently admitted that, maybe it doesn't work this time because the rise in unemployment partially is because of the rise in immigration and the entrance into the labor force. So I think you have that potential positive
Although,
catalyst.
Anastasia, it was interesting because Chloe Sun was on Yahoo Finance. And to your point, though, she was asked, in her words, she said she was very concerned about possibly tipping into recession. I mean, it wasn't that comforting to listen to Claudia, frankly.
I mean, I think we're probably teetering on the one hand and the other hand, of this indicator. But what I would also say is the Fed actually does have the tools to fight what might become what otherwise a recession. The Fed does have 525 basis points of rate cuts that they can deliver, and they can deliver quickly to the pockets of the economy that need it most. The reason why I think this is a different setup than, let's say, versus what we saw in 2007, 2008, I don't think we have the over-leverage issue in the economy and the over-packaging issue in the economy. We know what pockets of concerns are that were greatly, adversely impacted by higher interest rates, which is real estate, which is smaller companies that have a lot of floating rate exposures, consumers that were trying to buy a car or buy a home. But if the Fed quickly delivers, let's say, 150 basis points of rate cuts, I think that's what could stem that recessionary fear. And the other thing I would say, too, they haven't delivered it yet, but have you looked at 2-year yields? Have you looked at 10-year yields? Have you looked at the SOFR rate? Those have already reset lower. So I actually think they're already starting to benefit and providing relief to some of those pockets of weakness.
Anastasia, great to have you on the show today.
Great to be with you.
Thank you for joining us.
Thanks so much.
All right, Palantir's second quarter earnings are just crossing the wire. Let's get to those. Q2 EPS 9 cents. Street was at 8 cents. Revenue up 27% to $678 million. Street was closer to $652.85 million. So that looks like beats on the bottom and the top. Just turning it to guidance, Q3 Palantir saying they're looking for adjusted operating income between $233 and $237 million. That's a beat. Revenue, they say, look for between $697 and $701 million. That also beats. For the year, they are raising their forecast here. Now, for adjusted operating income, they're looking for between $966 and $974 million. That's better than expected. Revenue, they're saying they're now looking for between $2.74 and $2.75 billion. Street was closer to $2.7 billion. I did catch up with Palantir CEO Alex Karp. Julie, he's never one to mince words. On the quarter, Dr. Karp telling me we won on every paradigm. Everyone is struggling, he told me, but us. Other companies are built for a world of cohesion where things progress automatically, a non-violent environment. We are built for a different kind of world, he tells me. The world is melting down and we shine. That reaction in the stock, by the way. Palantir, of course, listen, they gained momentum with commercial clients, but early on, of course, very well known for their work with the Washington and the U.S. intelligence community. On the mega trend of AI, Karp telling us Palantir is uniquely positioned to capitalize on that trend. Remember, they offer their so-called artificial intelligence platform, AIP. They launched that about a year ago. We have the right software at the right time, Karp told us. That is why we win. And he said it's not our sales force, it is the product that's driving that.
The stock, by the way, has fallen 17% from its record high back on July 23rd. So it's been falling going into this report. The record close for the stock was 28.81. So I'm just looking at that number creep up there. That would be the number to beat, obviously, if it was going to make a new record. Speaking about that commercial business versus the government business, commercial sales up 33% last quarter, $307 million. Government sales up 23%. That 33% was sort of the target the company had to hit. That area I was seeing in some of the analyst notes was getting a lot of focus. The commercial part of the business had to sort of step it up, and it looks like it did do that successfully. So that, in addition, of course, to the forecasts and the other numbers, that seems to be one of the reasons why the stock is getting such a lift.
Yeah, in his letter here, Karp saying it may be easy to forget that only 4 years ago, we had 14 commercial customers in the U.S. We now have nearly 300. Some on the street I know heading into this print, Julie, they actually liked the company, liked the fundamentals. They didn't love the valuation. They thought it was priced to perfection. At least initially here in the after hours, stock is moving. Coming up, we are speaking to an analyst to take a deeper dive into Palantir's latest earnings as shares are soaring here after hours. Stay tuned to much more market domination overtime coming up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern. We're watching shares of Lucid now. The EV maker reporting second quarter results, also announcing a $1.5 billion investment from the Saudi Public Investment Fund, one of its major investors. The shares getting a quick 8 to 9% bump here. This is the second time this year that Lucid has gotten an infusion here, but it looks like it is necessary for it, right? And it looks like that it's part of two agreements with something called IR Third Investment Company that allows IR to buy $750 million worth of convertible preferred stock, and the other half is part of an unsecured loan. So the company's sales actually beat estimates, but it reported a wider loss than estimated.
Yeah, lost 29 cents a share on an adjusted basis. That was more than the 27 cents analysts had been looking for. Interesting. I mean, Lucid pure play EV, smaller than Tesla, has one vehicle now, but we know has another one, that SUV, coming later this year, Julie.
Right, and it's at a higher, at least it's
kind of the upper end.
It's an upper end, right?
Yep.
More comparable to a Model S, for example, than a Model 3 by Tesla. Well, the market sell-off continues. It's rolling into the start of the week. Former President Trump calling it the Kamala crash. How does the recent economic weakness impact her heading toward the election? Yahoo Finance's senior columnist Rick Newman is joining us now for more. So what do you make of this branding, Rick?
Well, unbeknown to most people, Kamala Harris took a break from campaigning. She flew over to Japan and she persuaded the Bank of Japan to raise interest rates to completely wreck the carry trade for people who are borrowing.
People who are watching, Rick is kidding, to be absolutely clear.
Yeah,
you got to be careful, Rick.
Thank you for the label. Well, let's see what happens in September and October. I mean, this downturn is shocking today, but it's not surprising. I mean, we've had guests on all day who know more about this than I do, but we've seen such a run up in tech stocks, the Mag 7. We're not even in correction territory yet on the S&P 500. I think we're just down about 9-point-something% from the peak. So it's some errors coming out of what was a pretty buoyant market. Just for comparison's sake, I did look up the numbers, guys. At this point in Donald Trump's presidency, the S&P 500 was up about 47% from the day he took office. And under Biden and now Kamala Harris, it's up about 35%. If you wind back to the end of July, the S&P 500 was actually doing a bit better under Biden-Harris than it was under Trump. And if you fast forward through Election Day, from the end of August in 2020, when Trump was running for re-election, stocks were basically flat. So if stocks recover here, and if they're, look what might happen. The Fed might cut interest rates in September. It might only be a quarter point. This panic over whether there's a recession might completely subside. And investors might say, oh, holy cow, we're actually getting what we wanted, which was a slowing economy, slowing inflation, and the Fed is now cutting rates. Maybe that will put some wind behind the sails of stocks again. So if we see a modest pickup here in September and October, I don't think there's anything to worry about for Kamala Harris's campaign. As we remind people all the time, what happens in the stock market reflects the real economy, but it is not the real economy.
How about, let's get some raw politics, Rick, while I have you. Reuters is saying Harris has now narrowed her search for a vice presidential running mate. It's down to two, according to Reuters, Rick. It is Pennsylvania's Josh Shapiro and Minnesota Governor Tim Walz. What do you make of that, Rick?
Well, I mean, flip a coin. You mean he's a popular governor of a state, Pennsylvania, that Kamala Harris must win. There's no way around it. If she doesn't win Pennsylvania, she does not win the election. And Tim Walz is this very folksy, likable, not well-known guy but he seems to have and he's a little bit older by the way than both Josh Shapiro and Kamala Harris. So he would in theory be able to like talk to normal people. He's the guy that sort of created the meme that Trump and everybody in the Trump campaign is weird. So he kind of represents the normal folksy vote. But for what it's worth, guys, I don't know that I buy the reporting that it's down to 2. But the good news is we have to know by tomorrow. So once we know, we can talk about it for 5 minutes, and then everybody can go back to watching the Olympics.
Well, I was going to say, Rick, how much does it matter, right, at this point?
Larry Sabato at the University of Virginia put out some interesting research on this, or his outfit did. In the best case, a governor might boost the vote for his party or for his ticket by about 0.5%. Now, normally that is not very much to get excited about. Now, we are talking about, in 2020, we did have margins that were below 1% in a few of the swing states. So, anything on the margin is potentially important, but you also have vice presidential candidates who kind of work against you. I'm thinking of Sarah Palin, obviously, for John McCain in, 2008. And J.D. Vance might not be working out. So, normally there's a lot of attention to the vice president while the pick is underway. And then everybody forgets about the vice president because it's not the vice president who's really running.
Rick Newman, thank you, buddy. Appreciate it.
Bye, guys.
Time now for what to watch. Tuesday, August 8th. Starting off on the earnings front, the season continues with a new batch of results. Tomorrow, Uber, Supermicro Computer, and Reddit all reporting, among others. Supermicro announcing fourth quarter results after the close. Analysts expecting big things as the company enters the Blackwell chip era, saying that Q4 results could be a precursor to sustained AI sales momentum in fiscal year 2025.
And moving over to the hospitality sector, we'll be getting earnings from Airbnb, Hyatt Hotels, and Wynn Resorts tomorrow. Airbnb reporting second quarter results after the bell. The Summer Olympics could be a tailwind for the third quarter. The generative AI features will be in focus on the call, according to analysts. The company is looking to bolster investments related to its chatbot feature in its app.
And finally, the Veep stakes could be over tomorrow. Reports say Vice President Harris has narrowed her search for a vice presidential running mate, and the decision is expected ahead of her public appearance with her vice presidential pick at Temple University in Philadelphia. Julie.
We'll see.
Yeah.
I'm really interested in the Airbnb, et cetera, in those earnings because we're trying to figure out what's going on with the consumer.
Less so in the pick, less so in the VP pick.
It'll be fine. But in terms of the markets, right? That's not.
Yes. Yeah,
the
you're
VP
right.
pick
Stay
will
focused.
have no bearing on
Stay
what happens
focused.
with stocks tomorrow.
Stay focused.
I am fairly confident, whoever it is,
You're 1,000% right.
that it won't affect that.
Absolutely right.
And that's our bread and butter. So that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. A bad day that could have been a lot worse. Concern around a slowing U.S. economy saw stocks plummet at the open, though investors calmed down as the trading day did go on. Stocks still closing deep in the red, though, with the S&P 500 seeing its worst single-day drop since 2022. Plus, crypto meltdown, Bitcoin hovering around the 55,000 mark after getting caught up in the broader market sell-off. At one point, the cryptocurrency fell below 50,000, its lowest level since February. Crypto-adjacent companies like Coinbase and MicroStrategy also suffered heavy losses during the session. And hot? Then not. Today's sell-off hitting big tech hard, with the Nasdaq sinking more than 3%, Nvidia dropping more than 6% amid reports of chip delays later this year as investors rotate away from the AI trade. We're taking a closer look coming up. The global stock rout deepening as the Dow plunges over 1,100 points. The Nasdaq Composite crushed by more than 3%. Yahoo Finance's Josh Schaefer here now with the trading day takeaways. Josh.
Yeah, Josh, it was an ugly trading day really across the board, and I was asking market strategists throughout the day essentially why that was, what they felt like was driving the action. An important takeaway that I thought that came through to us was that it's not just a bet on U.S. economic data coming in slower than expected that's driving this market action. We know, of course, that jobs report sort of kicked off some of this selling for us, and then we had an event last night with that stock sell-off that we had in Japan that also contributing to this. But I think part of what people are highlighting right now is just simply, if I can get us to the market action here and we'll take a look, just a lot of de-risking in areas that did really well, right? We're looking at the Nasdaq 100 here, and the biggest stocks that are in the red are some of the biggest winners over the last year and a half, right? I'm looking at this guy right here. I'm looking at Nvidia down 6%. Again, when you zoom out, the stock has been absolutely on a tear, right? So to see people coming out of those stocks isn't necessarily that scary of a thing when you think about the overall bull market. And this was something that Kevin Gordon over at Schwab explained to me. He said, take a look at the sector action. We'll even zoom it out to the last 10 days, sort of this decline that we've had. Look at what's underperforming the S&P 500. You only have two sectors, right? You have tech. Again, that sort of makes sense. Consumer discretionary also in that basket. But when you look at what's performed well, it's defensive plays, but there has been some sectors that have done okay. And he said he takes that action to largely mean that it's not a panic trade that we're seeing right now. People aren't in full panic euphoria. And you referenced off the top, Josh, it's not like we saw a sell-off that extended throughout the day. And I think maybe that's a key takeaway and a trend to take away from today is it's not like people panicked more and more as the day went on.
Yeah, it's another trend we were talking about on the show today, Josh, was just what reaction, if any, the Fed does have or should have. And I know there's been kind of that hot talk of whether the Fed maybe kind of steps in here before September. It's some kind of an intermediate cut, maybe a supersized one, not 25 but 50. And we talked though to Mohammed Al-Arayan on the show today. Mohammed said deeply skeptical that would happen because he thought if they really did that, just kind of the raw panic that would.
I heard the same thing from an economist today over at Deutsche Bank, essentially saying that in the same way that markets can get bet too much on what the Fed is going to do one way or the other. It feels like that's happening right now, right? We went from 3 cuts a week ago to 5 cuts expected in 2024 in a 5-day period. Maybe we're just moving a little bit too quick here off a few data points, and maybe the Fed's data dependency actually does make a little bit of sense, and we just need to see a little bit more.
All right, Schaefer, point number 2.
The point number 2 is just going to be a giant line up in the VIX, Josh. The VIX absolutely spiked today. It hit its highest level since 2020. And let me find it for us. It is highest level since 2020. I think our Jared Blickery said it was the largest point increase we've seen in the VIX in a given day ever. And so when you zoom out here, I want to take a look at the year to date because kind of the key point here being we haven't had a lot of volatility this year.
Look at that move.
So when you intro this kind of vol into the market, of course that's not going to be good for stocks, right? And I think kind of the key question that you get here, I'll zoom out a little bit more so this chart doesn't look so crazy for us, is where are the levels to watch? What sort of are you looking for? The team over at DataTrack had highlighted a range between, I think it was 27 to 35, so we closed at 38.
Those are the levels.
Those would be the levels, so a little bit lower than we are now is when they said you can start considering maybe this is a buyable dip. But the VIX has been one thing that people have been highlighting. Essentially, you need to see this stop just going straight up and bouncing very aggressively before you should feel comfortable that the market is settling down. Right now, we are being told by this signal that the market just is not settling down.
All right, final point from Schaefer.
Final point, takeaway 3, we had a big drawdown, so I always think it's important to sort of put these things in context.
Just take a breath,
right?
That's what you're saying.
So this is BMO Capital Markets, Brian Belsky's submission to the Yahoo Finance chart book. In the second year of a bull market, the average drawdown is 9.4%. When he submitted this, our largest was 5%. It's come down a little bit. We're at about 8.5% for the S&P 500. So we still have not hit what is normally the average pullback that we see in the second year of a bull market, which is what we're in right now. So this is just to say this is normal, and a lot of stock market bulls would tell you there's a chance that we could bounce up from here. You sort of capitulate, we have that tech selling that we talked about, and then maybe you get in a position to rally at the end of the year.
And just quickly, Josh, when you were talking to strategists today and they were kind of pulling out their crystal balls and looking ahead, what was their advice? What was their guidance to their clients?
They said a lot of people should be taking profits from some of their high earners. So that's why you're seeing people pull out of tech, right? And looking for places to go into cyclicals that maybe haven't participated as much in the rally. And then again, when we think about those sector action charts that we've seen, that's why you might have people going into something like consumer staples, right? They're going from a high flyer to something a little bit more defensive.
Taking profit and redeploying.
Yes.
Yep. Got it. Schaefer, thank you. Appreciate it. Moving on, Palantir reporting second quarter earnings, beating estimates on the top and bottom lines and raising full year guidance. And joining me now is Joe Bonner, Senior Securities Analyst at Argus Research. Joe, it is good to see you. So listen, Palantir reports, Joe, that stock is surging here in the after hours. Walk us through the report. What'd you make of it, Joe?
Yeah, good afternoon. They had a bar of 22% revenue growth. They came in, 27% total revenue. But the real performance indicator that I look at is that U.S. commercial revenue. That bar is 40%. And they came in at 57% growth. So really blew it out. Margins, we're looking for maybe 6-7 points of margin expansion. They blew that out too. I mean, so a really a great on a really tough day for tech stocks. It's a pretty great report.
And Joe, I'm just curious. They've obviously made their push into AI with AIP, and I'm just curious. What do you think their kind of competitive advantages are, Joe, in that space?
Well, they're taking a kind of differentiated approach here. They're not making their own large language model. What they're doing is taking their systems and marrying them with other models, basically, that are already out there, whether it's your commercial models like your Gemini or your ChatGPT, or like open source, or even their customers might have, their own, personalized models. Basically, so they're not spending big money on developing their own model. They're basically using those models with their own systems. So that's really their differentiation. Again, it's a lot cheaper. And there's kind of a thesis out there that maybe these large language models eventually become commoditized. So maybe it's not the best thing to go at their size investing in these big models.
And Joe, I'm interested. Heading into this print, there were some of your colleagues on the street, and they like Palantir, they like the company, they like the fundamentals. They were concerned about valuation. It just looked to them like it was price to perfection, is how one analyst put it. But Joe, you have a buy on the name, so you obviously still think here at these levels, valuation still attractive.
Yeah, and again, if you think about their business, they were government for a long, long time. Now they're expanding into the commercial realm, and whether it's in the U.S. or international, this is a big move for them, a big pivot into this commercial realm, and it could provide a lot of opportunities.
And finally, Joe, who would you consider, when clients ask, you're thinking about kind of the competitive landscape, who would you consider Palantir's rivals, really?
They don't have a lot of rivals. I mean, it's a very unique type of service. On the commercial side, there are companies like ServiceNow that do similar things, but not really the same, because Palantir's technology is is more for very complex problems. They're not your everyday software.
All right, Palantir, I'm looking at the chart, Joe, right now in the after hours, up about 17%. Not a bad move. Joe, thank you so much for joining us today. Appreciate it.
You're welcome.
Bitcoin off the lows after dipping below 50,000, having its worst week since the fall of FTX, though. The cryptocurrency is still sliding amid a larger correction across markets. Ethereum, by the way, briefly seeing its biggest single-day drop since late 2021. Here with more on the state of crypto, we have Bitwise Asset Management CIO Matt Hogan. Matt, it is good to see you. So, you look at Bitcoin today, Matt, and coming under this pressure. I'm curious, why do you think it came under pressure, Matt? Is it because investors see it as just, it's a very speculative asset because of margin calls? What are the reasons, Matt?
Yeah, I think you're pointing right at it. We've seen this before in history. This reminds me a lot of what happened in the early days of COVID. I remember Bitcoin selling off 37% on March 12th, 2020. That day we woke up to the reality of COVID. It's a speculative asset. It's a liquid asset that can be sold, particularly on the weekends. Those things combine to draw the price down substantially. But when I look at it long term, nothing much has changed about Bitcoin long term. If anything, the only thing that's changed in this market is we're closer to rate cuts. We're closer to, more quantitative easing than less. I see it as a long-term positive. So short-term sell-off, that's what history teaches us. But then I suspect we'll see a recovery in the relatively near term.
Why do you say that, Matt?
Well, that's what we've seen in history. The positive quantitative situations benefit Bitcoin. When the Fed lowers interest rates, that benefits Bitcoin. When they print more money to support the economy, that benefits Bitcoin. What we saw this weekend was challenges in Japan, challenges in the U.S. Economy, some weak economic prints. That means that we're closer to those easy monetary conditions, and that's historically been a time when Bitcoins thrive. So again, short-term setback, but I still think we're on track to recover this and indeed move on to new all-time highs later this year.
And you don't think, Matt, just to play devil's advocate, the kind of pressure Bitcoin came under, it didn't, in your opinion, sort of dent the case for Bitcoin, or at least one case you hear investors make, which is that it is a store of value?
Yeah, I do think it's a store of value, but only if measured over long periods of time. Again, I'll give that COVID analogy. We fell sharply at the beginning of COVID, but if you've held Bitcoin since then, you're up 500-600%. Meanwhile, the value of the US dollar is down about 25%. So to the extent that people think it's an immediate, overnight, daily hedge against market volatility, well, that's not true and hasn't been true for a long time. But for most Bitcoin investors who are buying for the next 3, 5, 10 years, its track record of storing value over those time periods is very strong. And I think we'll see that repeat again. I don't think history will change this time.
What do you say to Matt? Maybe some viewers right now are thinking, I'm going to move into gold. I'm going to add to gold. Forget digital gold. I'll just take the metal, because gold came under pressure here too, Matt, but a lot less than Bitcoin for sure.
Yeah, that's absolutely true. Look, I think it's completely reasonable for investors to hold both. We don't know exactly what the future holds. We don't know if the future is more digital or it's more physical, if people want the new thing or they want the old thing. We work with plenty of financial advisors at Bitwise who have an inflation hedge portfolio that's 50% gold and 50% Bitcoin. I think that's completely rational. I'm just not sure I would put 100% of my chips in either of those baskets. So to the people buying gold, I think that's great. I think you might consider some Bitcoin, and maybe vice versa. I think they work well together.
Why, Matt, did you see, I'm just looking at the charts, I mean, you saw Bitcoin come under pressure. Those Bitcoin ETFs, though, Matt, they seem to come even under more pressure. Why is that?
Well, what you saw is they had to catch up, right? Remember, those Bitcoin ETFs stopped trading on Friday at 4 p.m. They're part of the old world, and then they have to catch up on Monday. I'll tell you, actually, underneath the surface, we saw, net inflows to our Bitcoin ETF today. So I think we're seeing that Bitcoin investors are long-term investors. They're not sort of paper hands who are folding. I suspect we'll see net inflows across many of the ETFs today. We certainly did on BITB.
Final question here, Matt. I just want to talk politics for a second. It's interesting to me, Matt, how Bitcoin right now seems to be breaking down pretty sharply along these ideological lines, political lines. Matt, you saw Trump speaking at the Bitcoin conference. He spoke. I mean, I was just listening in. It seemed like the crowd loved it. But is that a healthy thing for crypto fans, Matt? I mean, don't crypto fans long term, wouldn't you like to have friends on both sides of the political aisle?
100%. I agree with you. You don't want crypto to be a partisan issue. Technology shouldn't be partisan. The internet is not a partisan issue. The best setup for Bitcoin is sort of stability from a regulatory perspective and clarity from a regulatory perspective. We don't want to be vacillating back and forth between two sides. I hope to see the Democratic side of the party sort of take on a more neutral position towards crypto. I actually think that is what we're going to see. So you're absolutely right. Partisan is not perfect. You want bipartisan. I really think that's where we're going to end up by November, but it's worth watching what comes out of the Harris campaign and whether they moderate what has historically been a fairly hostile approach to crypto. But I think people inside crypto who are talking to them say that that's probably likely.
All right, Matt, always great to have you on the show, my friend. Thank you for joining us.
Thanks for having me.
Coming up, is Nvidia to blame for today's major sell-off? Stick around. We're asking for a trend right on the other side.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
In today's broad market sell-off, tech stocks were among the worst performers, and Nvidia may be to blame. The information report over the weekend, Nvidia's state-of-the-art Blackwell AI chip is facing delays. The report rattled tech names at the open, but the tech-heavy Nasdaq did manage to pare some of those earlier losses, closing down more than 3%. With me now to talk about all this is Dan Gallagher, columnist for the Wall Street Journal's Heard on the Street. Dan, it's great to see you. I kind of want to actually start bigger picture, Dan, because you've been following the markets for a long time, and just get your take on kind of action we've seen in big tech, because got hammered today, but it wasn't just today, Dan. I mean, when we made our way through this earnings season, it was just interesting the way investors seem to have some new questions about big tech and that mega trend of AI, Dan. They seem to be saying it's great that folks are testing AI and experimenting with it, but where's the usage? Where's the monetization? Where are the returns, Dan?
Yeah, I think that really summed up this earnings season really well. And it was kind of unsurprising if you think about it, because it was going to always take a while for generative AI to build up into some kind of business if it builds up. But all the investment for it has to come before that. And this is a lot of investment, billions and billions of dollars into buying these GPUs, building these new data centers. And so I think there was always going to be these periods where the spending was going to really outweigh any kind of business or revenue story. We definitely saw that in this one. All four, I'll call them the four kind of AI giants, and that's Microsoft, Alphabet, Amazon, and Meta, had that was the theme of all their reports. And three of those four companies, their stocks pretty much has fallen and stayed down since they reported. Meta's the only one that's up.
And what was different about Meta, Dan? Because, they reported stock popped. Why did investors give Meta the pass there? What's sort of the distinction? What's the differentiation?
I think there was a few things. One, I think they had the stronger report out of those four, because the others, especially if you nitpicked a bit, they had, some misses in certain segments that kind of blunted the overall story. I mean, none of them were really bad reports, but they all, Alphabet missed on YouTube advertising. Amazon had misses across almost everything except the cloud. Meta had a pretty clean report, strong beats against the expectations, and that stock is the only one that was down from the March quarter reports, because if you recall, 3 months ago, Meta stock really took a hit, because that's when they first signaled all the spending they were going to do. Honestly, they kind of paid the price early, I think.
And Dan, let's talk about Nvidia too. I want your take on that name. Got hit today. We did see those reports could be delaying Blackwell. What did you make of those reports, Dan? And what should investors right now, if they're in Nvidia, what was your takeaway?
I think one, there was already some smoke in this area about buzz about issues with the design and how the performance was doing, possibility could be delayed. We saw that with AMD too. So it wasn't terribly surprising we're seeing this. And honestly, a 3-month delay is hardly fatal for Nvidia. They are ahead of the competition by years. So if it turns out to be the Blackwell comes out 2 or 3 months late, it's really just kind of shifting a little bit of revenue, I think, more than anything that's fatal. What I do think is going to be important to keep in mind, though, is that Nvidia is trying to essentially do new chips at a cadence that we've not really seen in this segment before. They're trying to do something new every year, which is kind of like a smartphone cadence. That's typically not what we've seen with data centers, especially these kinds of super powerful supercomputing type chips. So what they're trying to do is super ambitious. I think we're going to see a lot more periods like this, both not just with them, but with other chip makers, where they're trying to move very fast. And there's going to be probably some stumbles and obstacles they hit along the way.
Dan, great to have you on the show. Thanks so much for taking the time to chat. Appreciate it.
Thanks for having me.
And coming up, we're checking in on some of the tickers that are moving after hours. Stay tuned. More Asking for a Trend right on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Take a look at what's trending here after hours. Lucid shares on a tear. The EV maker announcing that an affiliate of its largest shareholder, Saudi Arabia's public investment fund, is investing $1.5 billion in the EV maker. Deal comes after the company reported higher than expected second quarter revenue, with sales getting a boost from price cuts. Also taking a look at shares of Hims and Hers Health under pressure here in the after hours. The company did raise its adjusted EBITDA guidance for the full year. Its second quarter revenue also beating expectations. In its earnings release, the company did tout early strength in its weight loss offerings. Hims and Hers began offering access to copycat versions of injectable weight loss drugs back in May. Eli Lilly's GLP-1s are no longer in shortage, raising questions about how long the drugs will be available from telehealth companies. And shares of Chegg sinking after the education tech company's adjusted EBITDA forecast for the third quarter fell short of analyst estimates. Despite the guidance miss, the company did enjoy a beat on the top and bottom lines in its second quarter. That's a wrap on today's Ask Me for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.